Hello and welcome back to another episode of Talking Wealth. My name is Michael Batnick. I'm a managing partner at Ritholtz Wealth Management. On today's episode, I am joined by Brandon Kawal, who is a partner at Advisor Growth Strategies. Today, we're going to break down the findings of their very popular, highly anticipated RIA Deal Room report. Brandon shares a behind-the-scenes look at today's red-hot RIA and M&A landscape, where deal volumes and valuations are at an all-time high, but buyers are more selective than ever. We'll explore what's driving record multiples, how the most successful firms are differentiating themselves in a very crowded market, and what both buyers and sellers need to know to create lasting value. Whether you're an advisor considering a sale, building for the future, or simply curious about the forces shaping wealth management, this episode offers sharp insights and actionable takeaways from one of the industry's leading thinkers. But first, a word from our sponsor. Today's show is sponsored by Innovator ETFs. Innovator is expanding upon the world's first dual directional ETFs with a listing of DDFO and DDTO. These ETFs allow investors to make money in both positive and negative markets. Innovator is offering both a 10% inverse and a 15% inverse version. For the 10%, if the market is down 10, you would be up 10, not just flat. You also get a one-to-one upside up to a cap. How would you like to make money when others are losing it? A strategy that's racked up billions in the structured product wrapper will now be available in an ETF. How has this not been done before? Find out more by clicking the link in the show notes. All right, Brandon, welcome back. Good to see you again.
Good to see you.
All right, we're going to get through it this time. Before we talk about the findings of the report and what is happening in and around the industry, for those who are unfamiliar with advisor growth strategies, what do you do and who do you serve?
I'll start with who we serve. So all financial advisors, the vast majority of our clients are RIAs, family offices, anything in and around independent wealth is our client base. That's all we do. So we don't work in any other industries. In our firm, we're a management consulting and transaction advisory firm. So long roots on everything from the custody side of the business, now on the consulting side, just serving advisors and how they grow their businesses. You know, what's the next phase of life for an entrepreneur and their wealth management business is kind of where we fit in.
Were you an advisor? How do you get into this industry or this role?
Yeah, so long time ago, I was an advisor. I was at Charles Schwab, and I worked on started out on the retail side of the business. Thought I would go the advisor track, and actually ended up in corporate strategy and focused on all of the offerings on the custodian supporting the custody side of the business. And that's how I learned the RA side and kind of the clearing custody and this sort of soon to boom industry that is now RIAs and everything we'll talk about today.
I'm always curious when you see these reports, and there are several publications that do this sort of stuff, about the methodology, because a lot of this is, well, some of it's public, but a lot of it is private. And even the deals that are public, you don't necessarily have the financial details. So what is the methodology of this report before we dive into it?
Yeah, so the methodology, about 8 years ago when I started wanting to do this research, I thought the same thing. It's like, well, how are you going to get this data, right? And why would anybody give it to us? So the methodology is simple. We go out to the market confidentially and we get actual transaction data. Some of it is our own. So we work on 10 to 15 deals a year at Advisor Growth, but I also go out to trusted sources in the market and get actual deal data. We also complement this with a buyer survey where we ask for buyers to essentially bid on fictional businesses that would be in the market to try to test real time sort of where
that sounds like
preferences.
That sounds like paper trading.
Yeah, so but just really more about their preferences of what they're looking for. Would you be in, would you be out type of thing. So, but the transaction data from the prior year, that's real. Those are deals that were done.
So how would you describe, before we get into like the meat of 2024 and what the study reveals, how would you describe the last couple of years in our industry?
You know, the last couple of years have been very interesting. So, you know, it's been hot and M&A has been quite resilient in our space. But, you know, if we think back not too long ago, 2022 was a big year of change here, right? So interest rates up, market was down, you know, we had kind of our first challenge, but the M&A market in this space was resilient through all of it. And I think that's largely because of one, there's a ton of value here, but there's a lot of demand, right? A lot of capital chasing this industry and a lot of, you know, tailwinds behind sellers. There's, we have an aging advisor base. We have a race for resourcing and growth. So I would characterize it as resilient and hot is the way that this market's been over the past few years.
It's really interesting you say that. So 2022 was a down year for markets, bonds and stocks both got hammered. But I wonder if that a lot of the financing activity in this space, it's not reliant on credit or interest rates. It's a lot of this is cash, whether it's private equity funds or other companies using their own balance sheet. Do you think that, well, maybe we just proved it. Do you think that interest rates matter to the M&A market?
They do, because what happens is when these firms take on their private equity backers, there's still a heavy reliance on debt post those equity infusions. So a lot of these firms are leveraging pretty sophisticated debt structures to go out and do a lot of their acquisition activity. So
all right, so forget everything I just said. So it definitely matters.
No, you're not totally. So it because it does matter, but what happened is where let's call it 2019 to 2021, you had a heavy reliance on cash because debt was not that expensive, right? 2022 hit. Instead of it shutting down our M&A market, what we saw was buyers kind of tilt their structures a little bit, say, hey, a little bit more risk with the seller, but also a heavier usage of equity in the space, right? You roll your equity into my equity. And so that does tell you a little something, that the financing does matter, but they can't stop doing deals, right? That it's just innate it's professionalized, but it's innate to the growth strategies that we're seeing deployed today.
What happened to the multiples in 2022? Were they stable or did they come down?
Oh, they were stable. Yeah, we thought doing the research, we were feeling as though we might see a pullback, but what we saw was a flattening, but not a pullback. So in 2023 was the same story, kind of on the median. It was kind of fairly flat, like a modest downtick. So there's a lagging effect from the results of 2022, but all told, they held pretty strong.
You mentioned growth. These companies can't stop growing. Scale is the name of the game. Growth is everything. Peter Mallouk Creative Planning just bought Sageview Capital. That was a $250 billion acquisition.
Yeah.
I don't know what stops this race to acquire assets. I mean, do you think that there's anything on the horizon that would suggest any interruption at all? It seems like it's full steam ahead.
Yeah, we spent a lot of time thinking about that. I think it right now it's full steam ahead. I do think we are reaching a place of more professionalization in the space, meaning, it's not as, I don't think we'll see leaps and bounds, jumps in multiples like we saw in years past. I think we're starting to get to a place of the market's hot and valuations are high, but do they go materially higher in the near term? I don't think so. I think for the best businesses, they'll still get the best multiples, and the market will still be strong. What really stops it for me is there's so much demand that's not going to do it. Demand's going to wane when there's something really, really big within the markets themselves. So I think even more so than we saw in 22, that was kind of a downtick. But I think you're going to have to see something pretty significant in the capital markets, or a protracted downturn in the stock market for this to slow, and it's not going to stop, to slow.
There's a lot of demand. There's also a lot of supply. There's still a lot of companies that are ripe for the picking. And paradoxically, you could see a downturn where these companies, creatives of the world and the others, get even more aggressive, because now maybe if these smaller companies are eager enough for a deal and they're the only liquidity, like you might even see more transactions, which who knows. All right. So in 2024, according to Fidelity Investments, 2024 was a record-breaking year for deal volume, with 239 transactions paired with a record-setting median valuation of 11 times. This is from the report. So I have two questions. Well, let me start with the first one. 11 times what? What are we talking about?
Adjusted EBITDA, or sort of pro forma EBITDA, where most deals are getting done today.
And you're adjusting for what?
Adjusting for, it's really two buckets. One for standard one-time expenses, that generally would come up. So, that wouldn't be considered ongoing operating expenses. And then the other bucket, we'll call them synergies. It's a negotiation with the buyer and seller, but ultimately things that would go away through a strategic transaction.
Maybe owner's comp?
Yeah, owner's comp is usually the biggest one.
Yeah,
We can all pay each other. We can all pay ourselves how we want, right?
right.
So you're kind of going into a more standardized structure in that regard. So those are all points of agreement. But generally, whatever hits the bottom line after all that, that's what's trading.
All right, so I'm curious if there were to be like a scatter plot of multiples, does it cluster pretty tightly, or is it all over the place depending on size, succession planning, quality, like all that sort of good stuff? What does it look like? How tight is the multiple range?
There's a bit of a scatter, and the main influence, you hit it, is size. So and the size, there's a lot of scarcity, and when you're looking at deals at $1 billion plus AUM, there's not as many of them. They're bigger, they tend to have larger teams and more established growth infrastructure, so they tend to skew towards the higher end, and then you start to see a scatter around based on size. So the clustering is really median by size is probably the best way to say it, is where you'll see some concentration on the scatter plot.
Do you think there's an appetite from public markets for some exits? Because there will be a $1 trillion RIA. Let's just assume that creative gets there first. And at that point, there's just not enough sovereign funds on the planet, maybe there are, to continue to provide liquidity. The relationship with public markets and our industry is mixed at best.
Yeah.
But how else do these giant pools of money get liquidity?
I think it's coming. At some point, I think to right now, what we've only seen examples like Focus Financial that has now gone private, as we know. Even Corient, the CI is undergone their own transaction. I think at some point the public markets will be necessary. I think for now we've been able to. You've seen the industry solve that through sovereign funds, private equity, you name it. But I think it's inevitable. I just don't know. We need to have somebody go public that is a truly integrated wealth management business, an RIA that goes out and proves it can be successful. Once that happens, and nobody wants to be the first, right? But I think when you see that happen, the floodgates probably open a little bit more. One thing I will say though is our mixed results with Wall Street has largely been because when you look at Focus when they were publicly traded or others, Wall Street hasn't necessarily bought off on this, wealth management, high cash flow business thesis, right? In terms of a high growth.
Well, now they are.
But
I mean, with Morgan Stanley, one of the reasons that they've done so well is their wealth management business is a juggernaut.
So I think the more that happens, and that's one. The more that happens, they start to see how high quality these businesses are, and they should command these higher multiples. The public market will respond more favorably in the future.
There also is. There's no doubt. There also is a difference between Focus's structure.
Yes.
I know nothing about their economics, obviously, but just the way that they do business, the aggregator roll-up model versus a creative, like it's different, and they should be treated differently.
It's different. Yeah, and now Focus, to their CD&R took them private, and now they're, I think, going through the changes to become more like a creative in those. So that could be an interesting one to watch in the next few years, because maybe the public markets become their best bet.
So I've spoken with a lot of advisors over the years, and I get some details on some of the transactions that go on, not necessarily at the RIA to private equity level, but more in terms of like what some RIAs, whether they're venture backed or traditional, are offering these advisors in terms of a compensation package. And I scratch my head and wonder how. Like, I know the economics of my business, and some of the details of what I'm hearing. I'm just like, make the math. I don't understand. So what happens with some of these lousy deals? Like, is it just the end providers of capital to these investors just get subpar returns? Is that it? Or does the industry start to maybe sober up a little bit and go in a different direction and pull in? And I know it's like, it depends is probably the answer, but what do you think when you see some deals that you're like, who thought this was a good idea?
Well, I think two things. I think there is a diversification strategy that goes along with M&A. And it's not talked about a lot, but when you think about some of these firms that are doing between 8 and 15 deals a year, the reality is you're not going to hit a home run on all of them. So, but you're somewhat diversified because you've bought a number of them, right? So some you might hit a home run. I guess it's like venture capital investing, right? You probably generate most of your returns off of, a smaller subset, maybe a Pareto principle 80-20 type of
All
a
right,
thing.
so maybe it's like, all right, we're paying for growth. This
That's
advisor
right.
who we're giving a stupid deal on its face to is a beast, and they're going to 5x their business, and the returns will make sense then.
Yeah, that's right. And then subsequently, we will also make sure that we have the things we can control, which is our infrastructure, our organic growth channels, our marketing, those types of things, to put every tool in place possible to help our top performers be top performers. And then even when you do maybe miss on a deal that you do, that it's not necessarily a negative, it's just, lesser of a return than some of your others. And then if you can do that on average, you probably have pretty good results. And I think so far that's worked. Now, I think to your point, there could be a day that you do a big enough deal and it goes poorly enough that it could sober people up a little bit. I think if we see that, what you're likely to see is just, and we're seeing it a little bit today, is just greater scrutiny on the deals that they do, because to your point, there's plenty of supply. So these buyers don't have to do every deal they look at. In fact, they don't.
Are you advising sellers or buyers or both?
Mostly sellers. We don't do any buy side like search work, but occasionally we'll get called in by a buyer on a deal if they already have one and they need to be pretty creative. We'll offer ideas, but mostly sellers.
All right, so how does that work? Somebody comes to you and they say, hey, I've got 30 employees, $1.3 billion. I'm looking to take some risk off the table. I want to take care of my employees, get them some equity. What does that discovery process look like? Are you, obviously, I'm sure you're having conversations. Are you looking at how much is it the financials? How much of it is the infrastructure, the personalities? Like, what does your diligence process look like?
We do an entire front end, because we do a lot of consulting work. We do an entire front end. It's almost like a mini consulting module where our diligence is really around a couple of things: the people, the process, and then looking at, the objectives of the teams. Most deals right now contain two deals. There's the deal you're doing with the outside market, and then you mentioned a big one. I want to take care of my employees. They tends to have, there's some element of that too, which is the deal inside the deal. So we spend a lot of time up front trying to vet a lot of those things out. It's a very emotional process for somebody
Sure.
to go through selling their business. So you really don't want to be getting these, big topics on the table, like how am I going to take care of my team and those types of things. What am I going to tell my clients? You typically don't want to do that when you're in the process of meeting buyers, right? You want to have that pre-baked so you're in the best possible position. So we spend a couple of months up front doing nothing but internal work with our clients before we ever contemplate who we're going to market them to. And then we run a much more traditional M&A investment banking type process after that. But, for us, we really want to get those key issues on the table, because it's typically not the money that makes these deals fall apart. It's something else. And it's generally something more emotional, psychological.
What, maybe we already got to this. Like, all right, I was going to say what makes for an attractive target, but we already did that. How misleading are headline multiples? Like, when you see something, you're like, no, come on. But oftentimes there's a mix of cash and equity or some clawback provisions or whatever, or earnouts. So when you see like this top line number, how real is that?
It's not, it's real in the sense that I can say I sold my business for whatever that multiple is. But to your point, there's a story underneath that, and they're misleading in the sense that, someone tells you they got X multiple at 15, 17, whatever it is. The first question we always ask is, if you tell me you got 17X of what, right? And going back to adjusted EBITDA, that you can get to that number a lot of different ways, and there's a lot of different, sometimes, one of my clients called it funny M&A math that goes into that. But there you can put the first multiple of what, that's the big one. But to your point, there's really no deals in our space, and the very few examples that we can give where whatever that multiple is, you're getting it all up front. The standard deal structure in our space is, you might be between 60 and 80% at closing. You're going to have between 10 and 20% tied to retention of the business after you close the transactions, typically a year to two out. And then you're going to have a growth incentive attached to your deal that will ultimately factor into your total outcome. these are all factors that are pretty standard in our space, but so what you're getting at close versus what you might get if you perform are two different things. And I'd say that's probably the area that most are least educated on. You might hear it from your buddy, I sold for 15 times of what, and then how do you get it, right? Those are the two things that come into play. So they can be a little bit misleading in that sense of how what you'll actually realize could be different than what you say you sold it for on a headline basis.
How fast do deals get done?
There's typically 6 to 9 months is kind of a normal time frame. I've seen them. We've done deals as fast as 4 months. But if you're really doing it right and taking your time, keeping a good pace, but being methodical about the decision process, 6 to 9 months is the right pace. There's a lot of work that goes into getting these done, and I think the more you rush, the higher likelihood that, again, it's emotional. So when you start to hit bumps, people react. The variance of how they react is much higher, right? They can get the highs are really high, the lows can be low. So typically 6 to 9 months gives you enough time to think through all those things and digest it, and make sure that you're making the right call, because you're only going to do a deal once. So you need to. There's no reason to rush.
So you go through your process, you do what you have to do in terms of making sure that the numbers make sense, that the people are there, the succession plan, the philosophy, all the culture, all that good stuff. Do you present them with different options? Like how does that work?
We do. There's roughly 50 different, a little bit more than that now, buyers that are out there, of various sizes, capacity, strategies, that are out there. And what we do up front with our clients is we go through kind of an ideal partner exercise where it's like, okay, if you're going to do this, what are we trying to get out of it? One, but two, what's that ideal platform partner look like? Is it somebody that's a little smaller, somebody's a little bigger? You want access to additional services? So we maintain a database here of sort of the strategies of all these different firms and what life's like, with them. And we test our clients up front. So we don't run blanket processes with our clients it's not a spray and pray approach where you just send it out to everybody and see what comes back. I mean, we try to curate to what our clients are actually looking for. But I think that is more for our clients than is even the buyers to say, hey, like, here's what we've discussed. This is where you'll see high conviction in the market. There's a lot of choice out there. Sometimes there's diminishing returns if you talk to too many buyers that are out there. But yes, we do present them with different options, and we try to curate it too. The numbers, we're confident we're going to get to the numbers. It's really more about the other things, like what's the comp plan look like? What's the equity structure? What is the cultural vibe of this firm? Operationally, is it completely different than what you're doing? Is it somewhat similar? These are all things that matter to you, but they certainly matter to your team, who's typically in it every day. So we try to get that nailed.
How messy are integrations? Because I can't imagine that there are two RIAs out there that have same investments, same tech stack. Like there's no way. Everyone is a bit unique in that regards.
Yeah.
So what does that all look like? And at that point, are you fully removed?
No, we're in there because we don't do a lot of the heavy lifting. Like if you have to merge tech stacks, like we're not the ones doing that work, but we're certainly evaluating it up front, because you're right, nobody's the exact same. So it's how much change will you adopt here, and then is that an acceptable amount of change? So for example, if you're on Orion today for your reporting and you need to change to a different system, is that okay? Is it not? What is that going to look like? Integrations are always messy. And we tell our clients, look, there will be bumps in this, and don't think anything differently. Don't let anybody tell you differently. It's going, it's good to feel normal again in your new partner's infrastructure. It's going to be 6 to 12 months after the transaction.
I would guess that it's more common that there is seller's remorse versus buyer's remorse.
I think that's accurate. I mean, buyers they're pretty professional now in what they're looking for and how they want to get deals done. So, some are better than others, but generally they're going to be in a frame of what they're really looking for. I think sellers, depending on the level of education they had going into it, the level of research that they did. Look, these sellers are getting calls every single day right now. I mean, we survey this every year in our research. I think 96% said they're getting, 3 or more inquiries a week from,
Unbelievable.
buyers, bankers. I mean, so they're getting hammered. If in some cases they're taking that call and they may have not fully vetted the market, in which case, they may have some remorse, right? They may have made the choice, like, it's not the marriage you get out of, right? It's not very easy. So yeah, I think that's right. There's more seller's remorse than not.
All right, Brandon, if there are advisors listening that want to themselves one day have seller's remorse, how do they get in touch with you?
Email, it's always easy. Our website, advisorgrowthllc.com, has all of our contact information. LinkedIn, you can usually pretty easy to find. So feel free to reach out. Always happy to chat.
All right. Awesome job, Brandon. Really appreciate the time today.
All right. Thanks, Michael.